Good morning, Hubert Johnson here with Taxes Made Easy. Again, it's a beautiful day out here in Tucson, Arizona. We're kind of spoiled out here. We've been enjoying lovely weather. Um, but today we're going to wrap up talking about payroll cases. And then we're going to talk about how to actually complete the forms and what's required and why for a business case. So how to actually negotiate with the revenue officer to resolve your case. So we got a lot of information today, and I'm very excited to kind of cover this for you. Again, if you have any questions, you can always reach out to us through the smartmoneyculture.tv and the smc.tv, or look us up on guardiantaxlaw.com. Our phone number again is 520-485-7371, and we'll be right back. Welcome back, everybody, and want to thank everybody watching live or on rebroadcast here at Taxes Made Easy. And again, the name of the day today, we're going to focus on business case taxes again, and payroll, and how to complete the business financial forms and wrap up your case with the IRS. So before we do that, I'm going to share my screen. I want to talk about some of the things you, again, want to kind of provide a service and talk about some of the latest news coming out of the IRS as well, because these are important things that you need to know. And I, again, want to provide that service. So we're going to go ahead and share my screen. So actually, that's the wrong screen. We're going to go to irs.gov. So you can just type in IRS news, and this is how easy it is to get there. So go to the newsroom, and it gives you some, corporate jets is one of the newest announcements. But again, that doesn't affect most people. The IRS is stepping up audits. This is the key thing. So first of all, interest rates remain the same for the second quarter. They're currently at 8%, 5.5, 8% for underpayments, 10% for large corporate underpayments. So again, this number has gone up due to inflation. It's staying there stubbornly, but this is something that affects everybody. And this is as of yesterday that this came out. So again, every quarter they come out and they announce if the rates are going to change or not. It climbed very quickly to 8%, and now it's kind of sitting there very stubborn. Here's the audit, the article about corporate jets being targeted by high income groups being audited to make sure that they're not abusing business expenses. But I think this is the one that really matters to most. So Tax Time Guide 2024. This is really what I want to focus on, because this is what's going to help most people. And a lot of this is the same thing that I've been saying and touching on. And so this is really good as we're going into tax time to understand what's going on. So, and again, this is a weekly thing they're going to talk about, and how to make sure this is done right. So if you don't just trust me, go to the IRS. They'll verify most of what I'm saying. Again, get ready to file your 1040s. Get all your tax documents together. If you don't have them, file for an extension. Just make sure, or try to make sure you've paid up in full by April 15th to avoid the increased penalties on that, or the penalties for failure to pay timely. If you don't have it, you can get that information either through an online account with the IRS, or you can have someone pull your transcripts. So again, if you haven't figured this out, you can click on this online account. I'll take you to irs.gov, and you can access a lot of your tax information directly there. You have to get registered. You have to set up a live account. So it's not easy, but and here's another suggestion if you have an I-10. Some of the changes here, the deductions went up. Standard deductions went up, which is great. And then additional child tax credit was increased. And then you have this enhancement. So it gets into the weeds a little bit here. I'm not going to go into that too much. And some of the earned income tax credit talks about that as well. And then it talks about, the 1099Ks and this is really important for business owners, this 1099K, if you're a partnership, this is how your income from the business is reported. And you have to be very aware of this. So what's taxable, what's not taxable, good record keeping is key. So again, so I can't emphasize this enough. Good record keeping. And then a new thing this year is direct file pilot program. If you want to know more about that, just click on this link. And there are quite a few states, 12 states, in which you can go online to irs.com and do a free tax return. It's a pilot program. So expect there to be bumps. And one of my sons actually used this for their tax returns. He had just a straight W-2, very simple, very basic. If you have anything more complicated, contact a tax professional. So going back to our topic for today, payroll taxes. So I get going and I talk, and then I kind of run out of time. And we haven't really wrapped it up, but I want to make sure that we kind of flesh this out. So we were talking about TFRP penalties and how those can be assessed personally and against the business. So just want to make a quick reminder, who can get assessed TFRP penalties? Anyone that had any kind of control or a decision-making authority over whether or not payroll was paid. Now, if you were a minority owner and you knew payroll wasn't being paid, what does the IRS expect you to do if you don't have control of the company? They want you to sell your stocks, resign, go hands off, say, look, this is a problem. We're absolutely not going to deal with this because this is going to be a problem. So that's they want you to take some pretty severe steps. But the number one thing is, as soon as you know that there's an issue, address it. If your majority owner is not paying the payroll taxes, refusing to address it, you need to do something pretty drastic to step away. They don't want you to sit there and take the income from the business when you know that the company and the IRS's perspective is stealing from their employees. So they're not paying their FICA taxes, federal withholdings, and they're not paying Social Security, Medicare for their employees. The IRS, this is one of the reasons they're very aggressive about this. So they really are very aggressive about collecting this money to make sure that the employees have their Medicare, Social Security funded, and that the taxes that they're supposed to be paid in was paid in, because these are the withholdings directly from the employees' checks. So let's say you have 3 owners and you have the EIN. Don't forget about the EIN. Let's say a TFRP penalty, the revenue officer is assigned. She comes in and she'll set up an interview. The EIN, of course, is going to be held liable for the full amount. So not only the employee's portion, but the employer's portion, the other half of Medicare, Social Security. Now, if the business, if the EIN, the business under the EIN pays, they get on an installment agreement and they pay over time, it will take care of the liability for everybody. If the business goes under or can't afford to pay, then the 3 owners will be held personally liable for what was withheld from the employees' paychecks. So that's where it can get so nasty. And so they will go after the 3 business owners individually. And one business owner won't know what's happening with the other owners because it's all confidential. But the IRS will go after each one. Have I represented multiple business owners? Absolutely. We have a case recently where 4 people are involved, and we're representing each family involved, and to protect them individually, and address the business issues going on. So it happens. Life happens. Business can be tough. If you find yourself in this fix, come get help sooner rather than later. It's so much easier to address this earlier than not. I shared some horror stories yesterday. There's so many success stories. There's far more success stories than horror stories, as long as you get ahead of this, as long as you stay on top of this. I've dealt with embezzlement cases, fraud. I mean, there's so many things that can happen. Scams, people scammed out of money. But there's many, many ways to fix this if you are proactive and get out there in front of these issues. So how TFRP works. So let's say the business can't pay. Even if the business can pay, the TFRP penalty will be assessed personally to the 3 business owners. Now, let's say the business pays. If you have a good revenue officer and you're able to negotiate and establish a rapport, I frequently be able to set it up where the business is the only one they go after, so that you provide the information on the 3 owners, the personal information. But as long as the business pays it in full, they'll ignore the assets of the 3 business owners. Now, if someone has $500,000 in cash sitting in a bank account, the IRS very well might demand it. And then that creates a lot of friction between the business owners, because if one person's the workhorse but he doesn't have any assets, someone else is the investor with all the assets. The investor, or whoever has assets, might very well get burned while other partners walk. And I've seen it where the more responsible partners walk away, don't have a job, I'm poor, and they cry poor and they work under the table, while the more responsible parties that have a normal job afterwards get hit for the full amount. So this is why you really need to be careful. You need to make sure that these are being paid. And it's not about fairness, it's about making sure that these taxes are paid for the employees that the business stole from. That's how the IRS looks at it. So again, be very aware of what's happening if you have any kind of control. Secretaries have been held because they signed checks, or they knew and they're the ones that mailed out the checks, have been held responsible for this. And that's kind of a nasty situation. But anybody that had any kind of decision-making power or were involved in those decisions can be, and often are, held responsible for the total tax. So as long as the business handles it, the IRS doesn't usually go after the assets of the individuals. But again, you won't know what's happening to your partners unless they share that with you, because again, that's all confidential. So we're coming up on a break. When we come back, we're going to dive into the financial information for businesses, what the IRS requires, and how to get a revenue officer off your back and off your case. Welcome back, everybody. Hubert Johnson, just wrapping up talking about TFRP penalties. And so when they're assessed against people individually, how do you deal with them? Just like any other tax. You can put them in a hardship status. On the personal side, you can do an installment agreement, or you can do an offer in compromise. Whatever is paid towards the debt for one individual will lower it for all people involved, and will lower the business debt because it's all related. It's one debt, but they're just making it, others personally individually liable for it. So you can think of it as a joint and several liability is the actual term for it. So if one party pays it down, it lowers the balance for everybody. So on the personal side, what do you have to provide? You have to go through the 433A. You have to provide proof of income, proof of expenses. And just like we've gone through, you just walk through the 433A, and we've gone into that in a lot of detail. What we haven't done is talk about the 433B for businesses. So this is a different kind of case. To do a 433B, it's very different, and I'm going to pull up a 433B, and we're going to walk through it just so you can see exactly what it looks like, and we're gonna kind of explain what they're looking for here. So I'm gonna share screen here. If it'll let me. Here we go. Nope. Let me try that again. Here we go. Okay, so this is what the 433B looks like. It looks very similar in many ways to a 433A, but it's specifically for businesses. Again, a lot of the information will be different. You want the EIN, business name, address, county, web address if you have it, payment processor, PayPal, Authorize.net, whoever you use to receive payments, they want that. Why? Because this is a levy source for the IRS. This form should scare you. You're going to be divulging a lot of very important, sensitive things about your business. Credit cards, they want to know how much do you owe, do you have an merchant account number. If you're getting payments, and if you have credit cards that owe you money, they want to know everything. Partners, officers, LLC members, major shareholders. When your business owes, your personal information the business information is not so personal anymore. You have to disclose all of this. Payroll service provider. Who's handling your payroll? Do you have any lawsuits and bankruptcies? Just kind of have to go through all of this. They want to know, do you have any other businesses or affiliations, subsidiaries, parent companies? Basically, they want to make sure that nobody's hiding the ball here. What's going on, increase, anticipated increase or decrease in income? If yes, explain. And again, this is kind of going into the facts of the case. You want to sell a story. If it's a seasonal position, you want to explain what's going on with the company. Can you have cash on hand? Yes. It's different for a business because they know that you need so much cash for normal operating expenses, for ongoing operations. If you are keeping the business open or trying to, they will allow for a month or two of cash to be there to allow for the normal flow of business. Is there a save, business bank accounts? A lot of this, you just fill it in. Notes receivable. Accounts or notes receivable. So that's cash and bank. This is a big one. So anybody that owes you money, anybody that you've billed them out, you've done the work, you've provided the items, and they're supposed to pay you. This is all seen as money flowing into the business. And if you have big accounts, these are the vendors or clients that the IRS would love to garnish. They can issue levies that tell the individuals or businesses that they can't pay you. They have to send the money directly to the IRS. You do not want this. You have to disclose the information. But this is why it's so important to get ahead of it and be proactive. This kills businesses. And again, I've seen it happen. It's sad every time it does. Again, we work very hard to prevent this. But this is why you have to work with the IRS. You have to get in there. Yes, it's a fight. Yes, we're fighting on your behalf. But the best cases are where we get in there proactively, we have the information, we give it to the IRS, this is everything you're asking for, give us a resolution. As long as we do that, they have to follow their rules and regulations and give you a resolution. Once they do that, boom, they're off the case. But they can find out a lot of it. They do searches, they can find vendors, even if you don't disclose it. But once you disclose it, just be very aware that you are very vulnerable at this point. And that's why you have to move all the way through the process. You have to wrap it up. You can't stop halfway through. Again, without leaving yourself very vulnerable to levies and garnishments. One of the worst things about this is that and this is what actually shuts businesses down, is when the IRS starts levying vendors or major clients. The clients just don't pay. Why? It's going to go straight to the IRS. It's not going to go to the business. They're not going to be able to do the work, provide the service, or contract if they don't get any money. So the vendors go somewhere else. When word gets out that someone's having their vendors garnished, that kills businesses faster than anything else. Most of the time, the IRS does not have to padlock buildings. I've seen them done that. I do it, but that is the exception. Going after vendors and clients is a much more effective way for the IRS to kill businesses. And it just makes it impossible to function. If they're hitting their payroll process, not payroll process, but they're not only their accounts receivables, but their merchant services, any money flowing through your merchant services all of a sudden gets directed to the IRS. If they hit their accounts receivables, it really hurts a business very quickly. And one of the biggest mistakes I see is that people are under the impression, I'll pay them off as soon as I'll make a big payment once I get the next big payment. You can do that, but you need to communicate that to the IRS. You need to provide all the information. You have to keep them off your back, keep the ball in their court so they can't come after you and levy you. And if I'm a little passionate about this, because this is part of what I do. This is part of my why of what I do. If I can save a business, save a livelihood, that's what helps me sleep at night. That's what helps me feel good about what we do. So accounts receivables, list of accounts receivables are very important. You have to have that together. You should have that together so you can get paid and make sure that you're following up on that. Another one, any kind of investments that you have, any kind of assets that the business has, total investments. Real property, very important. If the business is on a piece of property that you own, as long as the business stays in business, they're not going to go after the property. They can file a tax lien against it. But if there's any real property owned, you have to list it out. They can search the EIN and find the property on their own. Vehicles leased and purchased. So as long as these vehicles are being used for the production of income, the IRS will leave it alone. If it's inventory, it even mentions RVs. I had someone who was an RV salesman. He closed out his lot, but he still had a few RVs that he was selling. Had to disclose that. And again, these are signed by penalty of perjury. You do not want to be lying on these forms. This is where you can get prosecuted for fraud if it gets discovered. And again, it's never worth it. True story. I had someone that had a business, and this is around 2010. They leased large equipment for construction equipment. So they had big Caterpillar tractors. They had bulldozers. They had large equipment that they would lease out. But what happened in 2010 to construction? This is after the crash happened in 2008, 2009. The market was just still in a really bad way. And they were fighting like crazy to hold on to this equipment because they knew if they held on to it for 4 or 5 years, they'd be able to lease it again once the economy turned around. But at the time, pardon me, at the time, that equipment was sitting idle. And they had no, excuse me, no idea when the economy would turn around. It could have been a year, two. A lot of people hoped that the economy would bounce right back after the crash of 2008 and going into 9, that the real estate market would come back, that they would start building again. It took probably 6 years for people to start building homes again. And even then, it happened slowly. It's one of the reasons why there's such a shortage of housing today, because we're still feeling the repercussions of 2008. And, they had such a glut of houses on the market, the prices dropped. There was so much excess inventory that why would they build? Didn't make sense to build when houses were so cheap. And so a lot of the people that had this equipment were left high and dry. And so they ended up owing the IRS a lot of money because their business just stopped. Most construction projects were just canceled. But they didn't want to sell this property. It was their business. That's how they planned to make money. But right now their business was dead. The IRS insisted that they liquidate the assets because it was not currently being used for the production of income, nor did they expect it to be used anytime soon. Now, when nobody's building, that's probably one of the worst times to sell an asset like that. But when you owe taxes and you have a large asset like that, the IRS is not looking 5 to 10 years down the road. They're very short-sighted when it comes to you paying them money. And so, again, they had to liquidate those assets, which was very, very tough for them. And unfortunately, sometimes that happens. So if you do have assets, be proactive. If they're not being used for the production of income, you can sell them and then you get to use them. Maybe pay down some of your debt, maybe get current on your estimated tax payments. You can use that to hire representation for you. If you have medical bills or if you, not medical bills, but if you have other bills or needs within the business, you can use those funds within your business. But if you have assets sitting there, not being used, not actively being used for the production of income, that's a problem. On the flip side, a lot of people have held off on purchases because we need a new truck, but we have this IRS issue. There are times where taking cash assets and spending it down for business assets that will help in the production of income makes sense. So again, the key thing with assets is it being used for the business, for the production of income? And if it is, the IRS will leave it alone as long as the business stays open. And again, a lot of times I have people come in, small businesses, well, they'll have 3 vehicles and they'll have a truck in their name. I was like, look, you're not going to get credit for more than 2 if you're married, filing joint. Who's using this extra truck? What is it used for? Oh, it's used for the business. Is it just used for the business? I was like, yeah, it's an old beater, whatever, we haul stuff around. We can move that truck under the EIN and the IRS will ignore it for asset purposes because they can't force them to liquidate it because then they wouldn't be able to run their business. So we do that regularly. If it really is a business asset, we can move it under the business and protect that asset. Again, this is has to pass a smell test, but again, in TAD, you need to list out all the assets, business equipment and tangible assets. So you can provide an asset list, and you should provide an asset list that has. And if you do an asset list, one thing I want to, and this even has this language on the form. If you provide just a straight list, you do not have to shoehorn it into what they have on their forms. If you have the same information on these lists, you don't have to fill all this out. you can just, it says any attachments. You can just provide a list of real estate, a list of vehicles, especially if it doesn't fit nicely on the form. You can print all that out. And I do that all the time where I'm not filling out most of the 433D. We're providing the list and the information from the business. Saves it so much headache from the people trying to fill this out. And we would fill it out for you. If someone just hands you the form and says, hey, fill this out, the IRS wants it, they're not really helping you. But again, it's absolutely important to have that list of assets out. Any machinery, large equipment, they don't want to know about hammers and skill saws or anything like that. Inventory is important. We had a case recently where it was someone that sold wedding dresses. Quinceañera dresses. And she had a lot of quinceañera dresses, expensive, and apparently they're almost as expensive as wedding dresses. That was an asset that we, in her business that had to be considered. Patents, logos, software, mining claims, any kind of real assets that you have that are marketable, include those. And then assets and liabilities. So really this is where any kind of liability debt. So if you provide a balance sheet, you don't have to fill out most of this out. So a balance sheet looks at all of your assets and all of your liabilities and pretty much gives the IRS an idea of do they have excess assets or not in this company. And again, the IRS revenue officers, they're not CPAs, they're not accountants. Some of them might have a little bit of an accounting background, but as long as you have a valid reason for saying, look, this is a business asset, I have very little problem. If they do argue it, I appeal it and get it approved. So here is where most people struggle the most. And we're actually coming up on a break. So we're going to dive into, this is really the profit and loss statement. And we're going to walk through this, what is allowable, how to complete this form, or just attach a profit and loss to it when we come back. But the three things that you really need for a business 433B, you need a balance sheet, asset list, and a profit and loss. That is 90% of a 433B. So make sure, this is why it's good, very important to have good bookkeeping, know what's going on, having good information where you can access that at your fingertips, or you can get it put together fairly quickly. So we're going to wrap this up when we come back from our last break here. And again, if you have any questions, give us a call and we'll wrap this up for you. Welcome back, everybody. We're going to wrap up talking about a profit and loss statement and what that is. So again, the asset list should be pretty straightforward. All the assets of the business by type, whatever you can think of. Balance sheet, well, and account receivables. So again, you got to have a list of account receivables. Balance sheet is, can include the account receivables, but really it's all of the positive things, everything, all the assets the business has, and a list of all the liabilities. So, loans, debts owed to other companies, etc. And again, any bookkeeper that does any kind of business work should be able to do that. Now, a profit and loss statement. This can be very intimidating, especially for smaller business owners that aren't used to these names. I want to break it down, and I've talked about this before. A profit and loss statement can be as simple or complicated as your business. If you're running a small shop, or I've had people literally write a profit and loss statement that's been accepted by the IRS in pencil on normal college-bound lined paper. So what does a profit and loss need to be a valid statement? It needs a time period. So first of all, what time period does it cover? So typically, it's usually for the prior year. So when you do your taxes, you'll see a profit and loss that's prepared by your bookkeeper or tax preparer that covers the year. So January 1st to December 31st. When you do these quarterly, you should always see the time period at the top. What time period is this profit and loss covering? So January through end of March, April, end of June. That's what you should be seeing. And so when the IRS asks for it, like if you're in a brand new year, they'll usually go off your previous year's information. If you are doing an offer in compromise, for example, or you're working with the revenue officer and you're halfway through the new year, they want to know what's happening with the business. So, okay, that's great. You can give me, if we're in August, they'll say, look, you can give me 23's information, but now that's 6 months old or more. Get us a P&L for the first 6 months. And this is very typical. So again, it depends on where you are in the year, if they'll just take the prior year's information or the first 6 months. And if you're getting pay stubs, W-2, it's easy to produce those new W-2s and pay stubs. And it shows pretty recently what you've made. For businesses, it's different. They have highs and lows. If you have a very high season during the spring and you just finish your high season, you can say, look, here's a high season during the spring. Here's my profit and loss for it. But it's not reflective of what my normal income is because we just finished our high season. And then they'll take a longer look at it. So very first thing is the time period that's covered in the profit and loss. Second thing, you don't have to have this, but you should have income for the business. If you don't have any income coming in, either your business is failing or it's struggling really bad. Now, word to the wise. So you should have some kind of income flowing into the business unless it's a brand new startup. Now, the IRS is actually very, I think, very forgiving for the first year or two of business. They know a lot of businesses struggle and don't make money until years 3 and 4 or 5 for a business. The kicker is when you don't make business if you don't have income or a profit for too many years, then they see it as you're playing a game here. You're not doing this for profit if there's never any profit. In worst case scenario, they can look at a situation and say, okay, I have someone that owns a farm. Wasn't turning a profit, wasn't planning on turning a profit anytime soon. I said, look, you got to show some kind of profit, some kind of income. Or eventually, they're going to determine this hobby, you're just running this farm for fun. And then they disallow all expenses to it, that's really bad. That also kills businesses because then you're paying taxes on your gross income instead of your net profit. So you have to list out any kind of income that you get, be thorough about it. And then you have your business expenses. Allowable business expenses. This is key. This is why you have to have a separate business account. Makes it very easy to go through a business account and say, okay, this is a business, this is a business, this is a business. And if there's a couple things that don't qualify, your CPA or bookkeeper, your bookkeeper most likely would say, hey, this probably should be in here. We need to get this out. Make sure we're not including this, or the IRS isn't going to allow for this, or this is how much they're going to allow for meals and entertainment, etc. The one thing you need to be careful about is if there is commingling where personal and business expenses go together or run through the same account, you can have a lot of legitimate business expenses disallowed because it just makes it harder to tell what's a business expense and a personal expense when they're mixed. So again, make sure that profit and loss statement is clean. Make sure your bank accounts support it. because that's what they frequently request, is the bank accounts to support the profit and loss. So again, it's just income, business expenses for a specific period of time, and then the net profit. And again, business profit can be positive one year, negative the next, positive the next. But if it's negative too many years in a row, that's when they can come out and hammer you and say, look, this doesn't look legitimate, you're playing some funny games here. And you want to avoid that. And one of the problems is if you have a business and you're not showing net profit, you are not showing, and you owe payroll taxes. They'll work with you on some of the other taxes, but payroll taxes especially. If you are not showing a profit, if you're not showing that the business cannot make payroll, and they don't care so much if you get paid. And they understand if someone pays themselves a normal salary, but if you're paying yourself a high salary, they might say, no, this isn't going to work. But if the business cannot afford the installment agreement required to pay the taxes, the payroll taxes owed, the IRS can make the decision for you and say, look, this is not a successful business. It cannot function normally and pay the payroll taxes that are already past due, and the IRS will move to shut it down. So if you're not showing that it's profitable, if you're not making it profitable, this is where people have to make the hard decision. And sometimes a lot of times we walk people through these decisions. Where is your business? What is reality for you? And sometimes, we've had businesses where they shut down part of their operations, they streamline, they get rid of unprofitable sections or services, and they refocus and retool and become profitable. But we have to take a hard look at things and say, okay, we need to make some decisions here. And that can be the best thing for your business. And sometimes closing down a losing business or an unprofitable business is exactly what you need to do. If it's hurting you and your family, creating liabilities long term, especially if you can't stay on top of your taxes, you have to make that hard decision. And that's something we help people do, but again, we fight like crazy to keep businesses open, to preserve people's livelihood. So once you get all these documents together, and this is a process, the IRS revenue officer is assigned to the case. You want to work with them as quickly as possible to get things taken care of. What do you need? Let's stay on top of this. Let's produce the 433P. Let's get the list of assets, balance sheet, accounts receivable, profit and loss statement. Let's get all those together in a timely manner, get all that to the revenue officer, and then we can look at some kind of resolution. One of the big things here that's missing is substantiation. They're going to want bank statements. They're going to want credit card statements. They're going to want, sometimes even the contracts or your last loan statement on vehicles, if you have loans against them. They might want leases. Again, they will send you a list of what's required. Now, here's a big thing that happens is that they will send you what's called a 9297 letter. It does not look like a normal IRS letter. It comes directly from the revenue officer, and if it's already been issued, I'll request it from the revenue officer if they've already sent it. But the thing about a 9297 letter is this is kind of like a final notice of intent to levy. It provides a list of documents that you need to provide within 30 days. And if you miss that 30-day deadline, that's where the gloves can come off and the revenue officer can come after you. So again, be very, very aware. It's called a 9297 letter. If you receive that, and you don't know what you're doing, get some professional help. If you feel like you're lost, contact somebody right away to get that addressed. That is a very serious letter. But I've gotten into conversations, and that's the thing. We know what needs to be done most of the time. So we'll put that all together. And if you're in communication with the revenue officer and you're getting things done, well, can they give you more time? Absolutely. And even then, they frequently give you more time. But depending on the case, depending on the revenue officer, if it hasn't been a good relationship, when those 30 days run out, you're open to levy. You're open to have all kinds of bad things happen to your business. So getting things into the revenue officer is very, very important. And so, true story here, I had someone, I was a revenue officer, it was a small business, and she came in and she asked for 2 years of bank statements. Technically, should she have been asking for 2 years? No. So I went to the client and said, look, she wants you to provide 2 years of bank statements. I could probably fight her on this. But here's the funny thing. Let's provide it. He goes, well, why would we provide it? I'm like, because she doesn't want to go through all that any more than I do. So we got it all together. It was a stack. And we mailed it to her, and she got it. And her very next call to me was like, could you help me go through this with some of your staff? And I said, when we have time, sure. Which meant no, but in a nice way. And he got exactly what he wanted. Don't be afraid. If you've got your ducks in a row and you're moving this to a resolution, don't be afraid of providing necessary documents to the IRS. And if you do a document dump on them, which means you provide them with everything they want, if they ask for everything in the sun, dump a stack of paper on them. Because then, one, you've complied. 2, they can't come after you. And 3, they just made their own workload much, much worse. So are they really going to go through all of it? Probably not. But here's the key. They have a checklist. And if you understand this, to close out a case, they have to run it by their manager. So they have a checklist that they have to complete. And once they do the checklist, they can give you a resolution. They can set up an installment agreement in most business cases, or a temporary hardship. You can do a balloon payment. There are options there. But the revenue officer cannot close out their case until they have checked off the necessary boxes. So the smart thing to do is get compliant. You've got to be filing payment compliant as soon as possible. You've got to be responding. You've got to have your books together. Once you do this and you help them check those boxes and they can say, okay, everything's put together. Sometimes it's not what the IRS wants. It's frequently not what the IRS wants. But if they can check off their boxes, once they check their boxes off, you can say, okay, this is the resolution I want. We should be ready for it. And if they don't like it, say, okay, run it by your manager, please. I know you don't like it, but hey, they qualify for this. And I've had plenty of times where they didn't like the final resolution, but we did everything we were supposed to. And they had to give us what we were asking if it was reasonable and within the rules. Once the revenue officer is off your case, you can breathe easy. You can step back, focus on your business again, and you can still, it doesn't mean you can't amend returns, doesn't mean you can't file for abatements. There's still plenty of things you can do, and there's plenty of times, again, with small businesses that we set up a resolution with a revenue officer, get them off their back, and then file an offer and compromise. And you can do that through a revenue officer as well. It's just a matter of timing and the relationship you have with the revenue officer if you want to do that later. But again, this it's all about helping them get done what they need to so they can get the case off their desk, and that's really what they want. Their whole goal is to move cases along. They're so overwhelmed, and I have a lot of success by being proactive and helping people wrap up cases successfully. It saves businesses, it saves people so much stress, and again, that's what we want long term, is that success and giving people peace of mind. So again, we'll be continue to talk about businesses tomorrow, but thank you for watching.